Welcome back to Defi Demystified. Again, my name is Dan Kraus, and today we're going to take a look at what's the difference between the you of today and the you of tomorrow. The you that's starting with $5,000, 100,000, 1 million, and you're growing and managing it into your first 100,000, your first million, or 10 million plus, just depending on where you're starting. What's the difference between the you of today and the you of tomorrow? I'd like to suggest that the difference is in your behavior. So my intent here throughout our time together is to empower behavior change so that you, myself, we collectively can become the kind of person as individuals and investors that can create new income, hold on to new income, and not spend things just right out the gate, right? As an example of how important your behaviors are, if you take a wealthy man who's self-made, give him $1,000, a vehicle, and a cell phone, and start him in a city he's never been in, by the end of the first year, he could start a business that's valued at $1 million. Similarly, if you take an individual who's used to struggling financially and hasn't developed the skills to build or sustain wealth, and you just give them, let's call it $2 million, most likely at the end of a 2, 3, 5 year period, they're in a worse position than they were had they never had the money in the first place, because they haven't developed the skills to manage, grow, and sustain wealth. The trap that a lot of people will fall into is they'll experience a period of prosperity. Then they'll raise their cost of living, whether it's the new house, the new car, taking on regular vacations with their friends and their family, just eating out more often. And then, inevitably something happens in either their personal life or the market. There's a market event, like we just had a crash recently, right? And their income drops significantly. And that can lead to financial hardship. And it's best, whenever possible, to avoid digging the hole in the first place. So in that example, they've raised their standard of living, and now they have to kind of scramble a little bit to either find another way to raise their income and sustain that lifestyle, or they need to regress, sell the big house, downsize, sell the car, buy a more affordable vehicle, etc. And that's never fun. It can also be really difficult and hard on a family. So whenever possible, it's better to avoid digging the hole in the first place than digging yourself out of it over and over and over. And we've seen that before, right? So weight loss is a good example. Someone losing the same 20 pounds for the third, fourth, or fifth time. Finance, if you're working your way out of credit card debt for the second time or the third time, etc. So if we go back up and revisit our prior example, would it not be better if we created such a solid foundation before raising our standard of income that it would be very unlikely for us to have to regress, regardless of what happened in the market, regardless of what happened with maybe one or two of our individual investments in our portfolio, regardless of what happened in our business? If we created such a strong foundation for ourselves financially that we were just okay to weather through a downturn in the economy, that we were just okay to weather through a downturn in our business, that we were just okay to weather through a downturn in our portfolio for a temporary period of time. Better yet, what if we could be more than okay? Well, I think it would be fair to say that it's going to take a willingness to do something different, right? So for many people, most prefer the certainty of misery to the misery of uncertainty. That's a quote from Virginia Starr. So let's say we have two doors in front of us. Behind door number 2, the known. Everything we know, 100% chance of the life we have today. Behind door number 1 is the unknown. It's a 2% likelihood of being truly happy. So here's the thing in life about the unknown, what's behind door number one. If at first you don't succeed, it's a door. Open it again. That's how they work. The idea is to perfect a skill set of maintaining wealth, growing wealth, tracking your money, and understanding the patterns in your spending over time. It's not something that happens overnight. Think of it this way. Have you ever pushed a snowball down a hill, like a really big snowball, like the bottom of a snowman? As it rolls down a hill, it gets bigger and bigger and collects more snow and gains more momentum and rolls faster and gets heavier. That's what we want to do in your finances with the power of compound interest. Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So the objective is to get you to a point through your crypto portfolio that you're earning compound interest. So I'm hearing you. You're thinking, but Dan, what about the crypto? Can we talk about crypto yet? Slow down a second, because investing is 80% psychology, 15% money management, and 5% tips, techniques, and strategies. It's important to know about the tip, techniques, and strategies, meaning how to buy crypto, how to diversify your portfolio in crypto, which projects you can look at that have the best returns. Those are important, but they're the how-to and the least important part of the whole puzzle. So we're going to talk about money management extensively, and we're going to talk about psychology extensively. So let's distinguish between the known and the unknown. When you're working in an area that you're familiar with, the known, you may feel comfortable and safe. You may have outcomes that are reliable and certain, meaning you get what you expect. In the unknown, you may be uncomfortable. You may have a high risk to your actions, meaning you're uncertain of the outcome. It may not be what you're expecting. There may also be a high upside. But here's the deal. If what you're already doing isn't getting you to happiness, then there's something missing. You got to go out into the world and explore and see what that is. So there's something in the unknown that's going to close that gap for you and get you closer to what matters most. So my point is that something's got to give. In order to reach that next tier, to take your $5,000 and turn it into 100,000, to turn your 100,000 into your first million, to take your first million and grow it over time to hit that 10 million mark, something's got to shift, right? And the reality is many Americans today are in debt. I think I've seen some statistics that as much as 80% of the population is underwater. And the amount of debt is just continuing to grow. So something's got to change, and it's going to be the behavior of the individual. So what does that look like? What we're going to do is talk about a couple more concepts, and then we'll dive into how to actually track your money so that you can start to make progress toward your financial goals. So here's the question. Are you moving closer to what's most important to you, or are you chasing more? What we find when we sit down with individuals and couples, most people are actually chasing more, thinking that more will solve the problem. I just need more income. Well, what we've already talked about is as soon as you have more income, your expenses creep up, and then you're in the same place that you started. How do we interrupt that pattern in the first place? That's the question, right? So we've got to stop chasing more for the sake of more and get really clear on what's most important to us, and then recapture resources that are going toward things that aren't necessarily as important, and reallocate them so that we can have more of our time, more flexibility, more freedom, and focus on what matters the most. If anxiety is powerlessness multiplied by uncertainty, then I think we could say that financial anxiety is the same as financial powerlessness multiplied by financial uncertainty. So we've got a bit of a number line here. On the far left side, we have low anxiety. On the far right hand side, we have high anxiety. And on the low anxiety side, we feel powerful and certain. On the high anxiety side, we feel powerless and uncertain. And what I'd like to suggest is that clarity is the fulcrum on which this teeter-totter lies. So if you're highly clear about your finances and where you're going with your finances and the small parts that make up the tools that are going to take you to the next level, so you'll feel powerful and certain and you'll have low financial anxiety. On the other hand, if you are completely winging things, you're not tracking your income, you're not tracking your expenses, you're taking on additional commitments financially on a regular basis without having any reference points, you may feel powerless and uncertain about how to manage everything over time. So with that in mind, let's talk money management. So this diagram comes originally from Rich Dad Poor Dad. It's where I learned about this concept. And it's really inherent to running a small business and understanding the cash flow for your small business. But what a lot of people don't realize, they themselves are a small business. If you're taking employment in the marketplace and trading your skills for income, you're kind of like a small business. So this applies not only to individuals with a job, but to individuals with just one income stream. The individuals who are financially struggling, their income's going to come into their world and it's going to go right out through all of their expenses. Individuals who are middle class have a slightly higher income. Their income comes in, they have liabilities, bills, and commitments and debt, and that income goes right out to pay for those liabilities and then for their expenses. Individuals who are in a better position financially and have assets, those assets pay their income, which then pays their expenses and liabilities. And the interesting part is you can have some mix of these. You can have your job and your salary and assets that start to pay you on a regular basis. Welcome to Defi Demystified. That's what we're here to talk about, projects in the DeFi space. But before we get there, it's really important to be clear on, how much cash reserves you have, how much cash you have available for investments, and what your monthly expenses are is what kind of helps you set the bar for that. So without that information, if we just dive straight into projects, I'd be doing you a disservice and I wouldn't be preparing you for making informed decisions, right? So if you're going to track your own money, start by sitting down and noting all of your different sources of income and what your total monthly income is. If it varies a bit, go through your statements for the last 90 days and figure out your averages. Something that you can hit, something that's consistent and reliable, and then make your plan from that. Same thing for expenses. If you spent a bunch of money on discretionary stuff, things that you don't necessarily need, I would sit down and average that out for the last 90 days and come up with an average of, hey, like, I've got some car projects and I've put an average of $1,000 a month into them over the last 90 days. Figure that stuff out for yourself so that you know at the end of the month what you have left over. The clearer you can be on what is discretionary versus what's required, your monthly nut is your required stuff, your discretionary is anything in excess of that you're spending. Like, let's put it this way, some questions to ask yourself. Like, if you're in a financial pickle, or if you really want to move to the next level quickly, you need to maximize the amount that you can save or invest, right? That makes sense. So if you're going to save or invest or pay off debt aggressively for a short period of time, how much do you actually need to spend each month? That's your monthly nut. One other question to ask yourself that may be of use is, do you have any stuff that you'd be willing to sell to increase the amount of cash you have on hand? Do you have any assets that are not performing as well as you'd like stocks or CDs, or even just a savings account, like in an online savings bank that pays a couple extra percent? But if we can beat that, it might be worth exploring, right? So, do you have any assets or stuff that, given what you know now, you wouldn't buy them again? So, a good example for this that happens for a lot of people is that you bought a home in the past, you lived there for a period of time, and then you moved, but you kept the old home and just turned it into a rental. Well, maybe it's not in the right location for a rental because you purchased it as a primary home in the past doesn't make it a good rental today. So maybe it's worth reallocating the resources in that house, and you wouldn't buy it again today, right? So you sell it, and then we can reallocate those resources elsewhere. So for now, if you're not entirely clear on what you're currently spending on a month on your expenses, if you're not entirely clear on what you need for cash reserves, and if you're not entirely clear on what cash you have available for investments, sit down, go through these exercises, figure out your monthly nut, and kind of discern how much cash reserves you need for you to be comfortable, and how much cash you might have available for investments. And while you're at it, you may want to take some time to set some specific financial goals. And the way I think about those is identify what you want by a specific date and then how much it'll cost. So your goals can represent one-time events, such as invest $5,000 into my portfolio, or recurring events, such as invest $500 a month into this project car each month until complete. I've got some example goals here on the screen. So, hey, I'm committed to eliminating, this debt in this amount by X date. I want to hire a personal trainer and spend so much per month by a certain date. I want to create income from my investments that's equal to my expenses. I want to create income from my investments equal to 3x, 5x, even 10x my expenses, whereby multiple projects pay at least 2 times my expenses so that I'm diversified. And if something bad happened to, one project, I wouldn't be significantly impacted. So goals for investments, to invest a certain amount of money into your portfolio by a certain date. Travel goals, life experience goals. The question is really, what do you want? What are you looking to accomplish in your finances? So if you find yourself asking if I can help in your particular situation, the answer is it depends. So let's talk and find out. You can schedule a time on my calendar at calendly.com/DeFi Demystified. And the first 20 minutes is kind of a getting to know you session to discover what's going on in your world, what your targets are, what resources you have to play with, and whether or not I can really help. So jump on my calendar if you like, and we'll go from there.